Good morning. My name is George Maxwell. I'm the Chief Executive Officer of VAALCO Energy Inc. We are a company listed in New York and based in Houston, Texas, with a focus on emerging markets, particularly focused on Africa. I'll give you an overview of the company in this presentation in the next 20 minutes, and then we'll go to a Q&A session after that. So here are some of the key metrics from our Q1 2024 results that we published in April of this year, and then the comparisons to the previous quarter. You can see that we're producing just under 22,000 barrels a day with an EBITDAX of around about $62 million for the quarter. Income per share is 6 cents and diluted net income per share is 7 cents. And we have shareholder returns, which is a mixture of buyback and dividends in the quarter of $12 million. So this is our global portfolio. Recently in Q1, we just acquired a non-operating position in Cote d'Ivoire, and I'll talk more about that later. But currently we have production operations in Egypt and Gabon and Canada, where we're the operator. And we have a development operation just initiated in Equatorial Guinea. You can see our diversified portfolio for Africa. With the new acquisition in Cote d'Ivoire, we are now in Cote d'Ivoire as well as also in Nigeria, where we have another non-operated position, deep water position with Exxon as the operator. In Cote d'Ivoire, the operator is CNRL, who we know very well. You can see that with the production operations, currently we're producing around about 10,500 to 11,000 barrels a day in Egypt. That's a working interest position. Working interest position of about 9,500 barrels a day in Gabon and about 3,500 barrels a day in Canada. Focusing on the recent acquisition in Cote d'Ivoire, it adds immediate production of just over 5,000 barrels a day on a working interest basis. It's due for refurbishment in 2025. The FPSO you can see there on the screen is going offline for refurbishment. That's something we're very experienced in because we just did an FSO change out in Gabon in 2022. So we've got a lot of project management experience in that type of operation. We've got the diversification of Cote d'Ivoire into further diversification in West Africa. And this adds material production and material long-term upside. We see the potential of this investment production through to 2038. So it's a significant opportunity for us. We acquired it for all cash at a very attractive price. So there was no debt or equity involved in this acquisition. So if you look on the key highlights of the acquisition, you can see that as at February, VAALCO on a flowing barrel basis valuation was about $19,100 on a working interest basis. And you can see the net consideration that we actually paid for Svenska was down at 8,900 barrels on a working interest basis. So that's a very accretive acquisition. Similarly, when we look at our 2P position, our existing portfolio is at $3, just on $3 per 2P. And we're acquiring these 2P reserves at $1.84. So again, extremely accretive. It's coming in in production, and with the estimated production through 24 and the first part of 25, we plan to fully recover our acquisition costs in cash during this period. So you can see what it does for our production. We moved from just on 22,100 a day working interest up to over 25. In fact, we're higher than that at the moment, but this is where we're giving guidance to. The guidance for 24 is up over 25,000 barrels a day. The reserves, again, we'll be updating the market on reserves in the coming weeks for this particular acquisition. But at the moment, the published numbers take our 1P working interest reserves up to almost 22 million barrels. And you can just see in that diagram there the subsea configuration of CI-40, where it's tied back to the FPSO and exports via SPOR to the beach for gas. So we are now at just under 28% working interest. The operator is CNR. The Baobab field was discovered 2001. It's been an attractive asset for CNR. It's been very attractive for Svenska in the times that they've worked in it. We see a lot of activity now happening around CDI, with big discovery made by E&I recently, and also some blocks to the west of us, sorry, the east of us, coming in with Murphy. So you can see the attractiveness of this particular play. And if we carry on moving to the west, you go into Ghana, where you see Tullow's Jubilee field. Moving to our traditional production area, which is in Gabon. And in Q1, we were just on 9,000 barrels a day, just slightly above our forecast. You can see our production uptime pre the reconfiguration was around 85%. 2022, post the reconfiguration with the new subsea lines and the coming into the FSO and a central processing facility on one of the platforms, our uptime is now at 97%, which historically is very, very high. So we've set up this production, a strong production base. We've reduced the decline curve with this reconfiguration, and we've set ourselves up well for the 2025 drilling program. This drilling program we're just still working on to finalise, but we will be talking about that in our Q2 results in August. One of the key things in the drilling program is looking at how we can rehabilitate the Ebouri field, looking at a couple of solutions to gain access to those stranded reserves. Egypt, as we acquired Egypt through TransGlobe back in 2022, we spent 6 months really working on operational efficiency, and we really had a very strong position in 2023, the second half of 2023 in particular. We had strong drilling results in 23. We had hugely reduced cycle times in drilling, where we took the average time to drill and complete, in some cases, down to 15 days from a historical high of over 40 days. As a result of that, we managed to drill, we're in a position where we can drill more wells at lower cost. And we actually managed to add an additional 3 wells into the 2023 program. Looking at 2024, the first half of 24, we've mainly been operating with a workover rig to arrest decline. In addition to that, we've now just contracted a second workover rig so we can accelerate the workover and perhaps again accelerate the arrest and decline. And we're still looking to commence a drilling program in the second half of 24. One of the key achievements we're proud of in Egypt is we did have a fairly poor health and safety record when we acquired it. There were a lot of LTI incidents, but now we've in the first half of this year, we're well through 1 million man hours and beyond 1 million now, without any lost time incidents. And this is very key to us to make sure that people come to work and go home safe. Canada, we've been drilling in Canada in Q1. Strategically, last year we looked at how we could make Canada more efficient, how we could make it contributive to the corporate structure, both in terms of profitability and cash flow. With that strategy of moving to 2.5 and 3 mile lateral wells only, and making sure we could acquire the land. If we were limited to 1 mile laterals, we'd acquire the land so we could extend those to 2 and 3 mile laterals. So that's been very successful for us. We've completed 2 wells and came online in May. The other 2 wells are now online, so we've now got all 4 wells online and in production. And we gave that update to the market a few weeks ago. With the initial rates of the wells coming on particularly strong for the first 3. You can see the type curve analysis we use there to predict it. But one of the key things about the investment in Canada, you can see there that in Q1 we were at 2,400 barrels a day. We're now up over 3,600 barrels a day with the extra wells on. And it's key to have the liquid ratio as high as possible. Equatorial Guinea is an asset that's been in the company's portfolio for some time. There are some quite exciting deep water exploration prospects, but what we're focused on at the moment is a shallow water extended reach development into a deep water subsurface target. We've talked about this for some time now. It's been delayed due to partner issues, but these are now all resolved. And we'll be moving forward, and we have moved forward actually with the commitment of the FEED study. The FEED study is two key objectives. One is to make sure that the seabed survey is carried out so that we can actually place the equipment in a condition where the mudline is suitable and in a condition where location where we can actually drill the extended reach to the reservoir. And secondly, to look at how we can optimize and reduce the capital cost for the project, perhaps swapping capex for lease opportunities due to the short tenure of the project and to reduce the cash sink. So we're looking for FEED. The FEED study will go through 2024 towards FID either at the end of 24 or early 25. And you can see with the change in the economics around the agreements with partners, you can see that we've actually, with that deal, enhanced our entitlement to 1P by about 200,000 barrels. So certainly a good deal for the company. So if you look at what's happening in the company over the last few years, you can see where we were in 2020. We came in, that's just around the time I started, with a mandate to grow the company, grow production, grow reserves, and create longevity and diversification. And you can see in that chart that we've been accomplishing that year on year. This is a full year 24 estimate for working interest production, up over 25,000 barrels a day. And with the assets we've now got in our portfolio, we've got some key catalysts going through 2025, 26, and 27 to increase that production. Again, when we look at our SEC position year on year, we've improved, and that's despite some big adjustments because of the oil pricing that's been taking place through the way the SEC calculations is. But another benchmark is to look at our 2P position and working interest, and you can see we've added substantial longevity to the company in 22, and again increasing in 23. These positions do include some of the Svenska, but as I said in the last earlier in the presentation, we'll give you an update to market in the coming weeks with regard to the adjusted reserves now that we've done the analysis and a new competent person's report on Cote d'Ivoire. We don't look at country-specific netbacks because tax and fiscal regimes are completely different, but we do look at blended netbacks at various prices for the year. So you can see our blended netbacks for the corporation and how those are made up at $70, $80, and $90 oil. And you can see even at the lower level of $70 oil, but we still have a healthy contributive position of $24. Obviously, increases a lot more when we get to $90. But that allows the investor and the reader to make an assessment of our potential for our earnings potential within the guidance frame that we give it, which is we give a guidance frame on production, and we obviously give these indicative netback positions. When we look at the company's liquidity, again, we made a couple of key decisions back when we came in. One was we needed to have a debt line to ensure that we safely perform some of our investing operations with little or no risk to the equity position. So we have a debt line in place. This is pre the acquisition of Svenska, but as at Q1, over $100 million of cash in the balance sheet. We also had a position where we initiated a share dividend. The first time that VAALCO's done that, we kickstarted that at the end of 21. And then when we acquired TransGlobe, made a commitment to double the dividend. And you can see we've been delivering that consistently through Q2 as well, up at 6 cents a share. In addition to that, we made a commitment in 2022 to do a $30 million buyback program. That program is now completed. It completed in Q1 24. And we've made that commitment. We've spent the $30 million and we were buying the stock back at an average of around just somewhere north of $4. So this is the guidance we give for 2024. This now does include does not include Cote d'Ivoire, because this is before we had the position in, but we've added it in at the bottom there. You can see So we're now looking at a range for working interest positions of around 27,000 barrels a day. Our NRI, we also give both working interest and NRI. The NRI can move, obviously, because of the way the PSCs operate. And we give guidance on production, CapEx and G&A. So you can see our guidance ranges there, where we see the CapEx from about 115 to 140 million. So for us, a relatively light CapEx year. Next year will be a little bit heavier. I'm not going to go through these in detail, but you can see here what we're trying to provide is there's been a lot of discussion in our previous presentations about how the effective tax rate can move. And this is just giving you an example about where, if with higher oil prices we recover the cost pool in full, then you could be in scenario 2 with a reasonably high or normal CapEx spend. You'll be in scenario 2. If we have a very light CapEx spend, as we do this year in Gabon, then the effective tax rate increases because the profit oil is higher because there's less cost oil to be deducted, and the ratio split between us and the government changes. So you can see through these scenarios how you affect the effective tax rate through investment. So a good investment, a high investment year as we will have next year in Gabon, where we won't have a fully recovered cost pool, you can see that would be scenario 1. And this year, 2024, is closer to scenario 2. But it's just to give you an indicative example to try and give you an education of how the PSC and royalty structure works for these. And there are some big movements because we have what's called in-kind taxes. So we continue to store the barrels for the government for their tax take until such time as they off-take, and they're always marked to market. So you can see what happens to, again, our effective rate when oil prices go up and when oil prices go down. Again, this is just more an educational slide. This is purely a one for the finance guys. It's for all the things we've talked about before. This is just a reconciliation to non-GAAP measures so that we can talk with a degree of knowledge as to what's into US GAAP and what we talk about and things like adjusted EBITDA. And that's a brief summary of where we are and what we're doing. One thing I'd like to add is now with the acquisition of Cote d'Ivoire, we have a number of organic catalysts over the next 3 years to cause major triggers. We have a drilling program that's planned for Gabon for 25 and 26. We have a drilling and development program planned for Equatorial Guinea, which is taking place the end of 26 and early 27. We have a drilling program taking place in Egypt this year and looking to further put a plan in place for the Western Desert acreage that we're trying to put in place for this year. We continue with a strategic plan in Canada, which is just 4 wells a year to continue to make a positive contribution to the corporation. And in Cote d'Ivoire, we've got a very accretive asset at the moment. It goes offline for about 12 months, and then when it comes back, we will have a phase 5 drilling campaign. It's currently planned, and we'll be talking more about that once that's confirmed. So over the next 3 years, just within the portfolio, we have significant growth opportunities, significant triggers happening at different times, and the company is well positioned with a exceptionally strong balance sheet with no debt to be able to fund these positions through 2027. Thank you very much.
So George, thank you for being here today. Could you tell us about yourself? Who are you, and could you walk us through your career?
I've been in the oil business my whole career. Started in the North Sea in Aberdeen with Texaco. Was there for some time doing petroleum economics and the fiscal side of the business. I then went and worked for ABB in their oil and gas division. I was based initially in Aberdeen, then in Houston, then Singapore, then the Middle East, Africa, and finally back in the UK. After that, which was about 2003, I left and I joined a small oil company called Arex Petroleum, which was based in Geneva. I spent 2 to 3 years in Nigeria working for them, and then moved to Geneva to form the business development side and the planning side. and we worked on acquisitions in Gabon. So the position that VAALCO is now the operator, I was part of the team buying into that back in the Pan Ocean days in 2006. So I knew the asset pretty well by the time I came to VAALCO in 21. We built the ADAX was built up. We got assets in Kurdistan, in Cameroon, Nigeria, and in Gabon. And the company was sold in 2009 to Sinopec for over $9.5 billion. At that point, I decided to set up my own oil company. So in 2010, I formed a company called Ellen Oil and Gas with my partner, and we basically looked to acquire assets in Africa and raise capital for acquisition and development. So we acquired an asset in Nigeria, OML 40. We raised about $180 million in London. We listed the company in London in 2012, and we got that asset back on production in 2014. And then subsequently, we had it up to close to over 32,000 barrels a day, and the company was acquired in 2020 by Seplat for about $500 million, including the acquisition of debt. So that was a very successful position for everyone involved. And then I was asked to come in and take over VAALCO. So with a mandate on VAALCO to utilize the experience we have in Africa to de-risk and grow the company in a portfolio basis and in a financial basis. And I think when we look at where we've been in the capital market space in New York, we've certainly improved. We've had multiples of our stock price in the last 3 years. We've taken the stock liquidity from relatively modest volumes of under 200,000 shares a day to over 1.3 million shares a day. And we've now got the company indexed in the Russell 3000, so it has that indexation volume as well. So that's my background.
Excellent. And how many shares of VAALCO do you hold?
I currently hold about 370,000, something in that region.
What would you consider to be your greatest achievements at VAALCO so far?
I think there's still to come. I think we're on year 3 of what I consider a 5-6 year plan to take this company way beyond our evaluation basis. We're looking to go well north of $1 billion. So we're not there yet. We're valued somewhere around about $700 million. But so the achievement is, first of all, stabilization and making sure you have the right team around you, because this is not one man's achievement. It's a team's achievement with support from the board and the shareholders. So getting the right team around you to make it happen, that's the first key achievement, I would say, because nothing can happen if you don't have the right people around you. Once you've got the right people around you in the right locations, then you start to hear about the opportunity. And then it's just about the idea of which opportunities do you want to spend time pursuing, and which ones are interesting, but maybe not for us. So if you wait for the bank to tell you what the opportunities are, you're already behind. You've got to have people on the ground that can hear what these opportunities are. So building the teams is probably the greatest achievement to date, but it's only the platform to allow us to grow further.
So you speak about team. How have you built the management team at VAALCO, both the top level and also on more country level?
2 ways. Obviously, we've been in the business a long time, so you build up a reasonably strong Rolodex of people who have like-minded experience in what it takes to motivate and move and build a small E&P company. You can't be everywhere, so you have to be the expert in the areas you choose to be in. So what we do is make sure that the people we've worked with in the past, the people that we've admired in the past because we're in the same space, those are the people you try to bring into your team. And people who are, I spend probably every second week on an airplane, so there has to be a commitment that you're going to be away from home doing things in Africa or over in Houston or up in wherever we need you to be. So having the ability to work on your own, because you don't always have access to the team, different time jurisdictions. So nearly everyone in the team are self-starters. They have the capability to come forward, not with, I have a problem, but here's a problem and here's the solutions I've already deployed. And that's key, because with the time differences, it's not always possible to wait for someone else to give you the answer.
If we speak about the ownership of VAALCO, how is it divided between retail and institutional, and who are your largest shareholders?
So we're probably about 60% institutional now. We were about 35% institutional 3 years ago, so we've changed that balance slightly. There's about 2% is owned by management, and the balance is retail, so about 38% retail, something like that. Our major holders are, because of where we are now with indexation, would be the normal guys that run the indexation side, the Vanguard, SSG, BlackRock, are 3 or 4 largest, biggest shareholders. But the largest shareholder is probably around 7%. So we don't have any overly dominant shareholders.
How would you say that VAALCO stands out compared to other E&Ps?
I think, we never. It's always difficult to give the comparison to someone else in the sector, because every oil company faces different challenges based on the geographical positions they're in and the size of the company. We are pretty strong on financial stewardship. We are very strong on operational efficiency. That's where I think our 2 key strengths are. We're quite cautious with the money, and we're once we get into an operation, and you saw that from the presentation, to bring Etame up to 97% efficiency from downtime is just as an example of what we do and how our operational excellence can produce more oil. And that, again, was testament to our capability of what we did in Egypt. Cutting cycle times by over 100%, from 40 days down to 15 days, tells you how we can do things efficiently, and with monitoring our health and safety record, we do things safely as well. So those are our 3 key strengths.
So you recently bought the Svenska Petroleum Exploration for $40 million, a Swedish company, or at least incorporated in Sweden. Could you give us the rationale for the acquisition?
Yes, it was a Swedish headquartered company. That wasn't the key driver. The key driver was always for us is what's in the rocks. So the rocks and the opportunity inside Cote d'Ivoire was key. We saw an attractive opportunity that would be very complementary to our existing portfolio, with the objective of getting all of our asset bases right into the mid-2030s from a production life. This one already had indications that it had production life through 2038, so that was attractive. We recognised that it required investment, so and the opportunity for that investment dovetailed quite nicely with our other assets. So we weren't overstraining the company in any one period if we went after this particular asset. And the upside potential later in life, through in 2027, 2028, we found very exciting. When you couple that with the assets being up for sale for some time, we had looked at it previously, and we put a position towards the seller previously. And we have, we're quite easy to deal with. We look at the opportunity. We put forward what we think is a fair offer that's accretive to the seller or the seller's shareholders, but is also accretive to our shareholders and what we're trying to do. We do obviously negotiate, but we always have a cut-off line. So there are many positions that the market's never heard about that we do go after, and it gets to the cut-off line and we walk away, because the value is just now. We're not trying to do something for growth just for growth's sake. It has to be able to be complementary to the strategy and contribute to it. And this particular opportunity fitted that very, very nicely, and particularly at the price we we finally negotiated, I think was a very attractive position for us.
How is your relationship with the operator, Canadian Natural Resources?
Well, as luck would have it, CNR, obviously they're based in Calgary, but their operation for Cote d'Ivoire is actually run out of Aberdeen. So Aberdeen, being an oil centre, but also being a small town, you find out that the people running CNR here, we know them, and we've known them for a long time, as we've all grown up together in the oil business. So I think the personal relationships are very strong. The corporate relationships are developing, and our focus on making this project a success is absolutely aligned. There's no disconnect there whatsoever. So it's actually quite an easy one for us to slot into, to be as contributive as we can with the experience we've already had, without being courteous. We're not the operator, but we're here to help, and we're here to make sure our investment provides a great return.
How will the acquisition impact your G&A, which currently sits at about 22 to 25 million per annum?
Yeah, I mean, G&A is a big focus. I mean, yes, it will impact. I think we've got $2 or $3 million of additional G&A to add to this, but that's it. There's no other significant costs in acquiring this operation. There were some synergistic costs that we managed to take out of the business, because I think we think we're adding $2 to $3 million a year on G&A. I think they were running closer to 12 or 15. So when you look at consolidating G&As, as we've looked in many of our acquisitions, I think my CFO is not here, but he would be telling you we've probably taken $15 million out of G&A through these acquisitions in the last 2 years, when you couple them together. So it is an efficient acquisition that we've brought on board. The only other thing we've done, as we do in every part of our operation, as I mentioned to you earlier, we've opened an office in Cote d'Ivoire. We have a country manager in there, because wherever we are, whether we're operator or non-operator, we want to have representation in the country. But that's a small additional cost.
Awesome. Yeah, it's good. Yeah, it's good that you point out that not all is far from all is cash. Other G&A, and so the production, you will be doing some FPSO maintenance and upgrades in 2025. 2026 drilling will resume at the Baobab field. What production should we expect in 2024 and in 2025? Working interest to you.
Okay, so working interest, we provided guidance in that presentation. We're currently producing just around 5,000 barrels a day. We expect that to decline throughout this year, but I think we're still guiding to around about 4,500 in that region for 2024. We haven't given guidance for 2025, and we won't do that until the end of the year. But it's well acknowledged that the FPSO goes off station in Q1 to be refurbished, so there's unlikely to be much contribution in production.
What's the operating netback at $80 Brent ballpark?
Yeah, again, that's why we provide the presentation. The netbacks in Cote d'Ivoire are better than many of our positions, so they're very strong. But they do form part of that blended netback that we presented earlier, and that's kind of where we keep it. It is a strong netback because the PSC terms are particularly attractive. But yeah, we won't be quoting individual netbacks for the countries. We look at how they contribute, and we look at what they can, the blended position for the company at various oil prices.
Could you give some overview or some color to the taxation and royalties that are paid in Cote d'Ivoire?
Yeah, it's very similar to Gabon, really. I mean, the tax and the royalties aren't worth mentioning. They're very small. The tax system is paid through the profit oil. So when you get to the profit oil split, the barrels that are attributed to the government take care of your tax position. So similar, if you were looking at the example we provided for Etame, you can see how the PSCs work. The difference, I think, in this PSC, we have a much higher return on the invested capital. because there's an uplift on invested capital. So when you look at a heavy capex year that we're going to have next year, and building up that cost pool, not only are you building up a cost pool for the dollar you've invested, you've got that cost pool growing by that uplift as well. So by the time we come back in production in 2026, we've got a substantial cost pool to recover. So there'll be much higher cost oil positions awarded to the operator and the contractor group throughout 26 and into 27.
Excellent. And what color could you add to the drilling program in 2026 in terms of scope and potential costs?
Not very much. I mean, we know there's a drilling program planned. We know the operator's been discussing that with the regulator in Cote d'Ivoire. They've been mentioning it to us, but the detail of the plan is still well over a year away. So until we are ready to, or the operator's ready to go and contract the rig, there's really not much we can say about that in terms of scope, how many wells, in terms of production, in terms of cost. Obviously, we have our own estimates, but we'll wait to see when the plans of the operator are ready to communicate.
You now 21% of OML 145, an offshore field operated by Exxon in Nigeria. It's not in production. What's your plans with that? And do you know also what Exxon if they plan on executing any development in the next couple of years?
Yeah, we had a look at that when we were doing a due diligence. It's a very deep water block. Exxon are the operators. I think Chevron and Oando are other partners in there. At the moment, the discoveries that are on the block, I don't think the partnership sees them as economic for a development. So there's two key elements. One is the time frame that's left on that particular PSC, and the cost of developing the limited resources that have been discovered. So for us, we don't see a lot of value or a lot of opportunity in that at the moment. But we're there. We're looking at it. I mean, times change, values change, cost positions change. So you never say never when you have acreage. But this one looks like it would be a challenging one to develop economically.
Could you just give us a quick overview of the Etame field? Oil quality, production, etc.
Yeah, well, currently we're producing between 16 and 17,000 barrels a day gross, so about 9.5 working interest to us. It's really improved. We invested some $250 million in the field through drilling and reconfiguration back in 2022. Again, the recovery of those costs, that's fully recovered in just over a year with the cost pool. So that shows you how attractive the investment can be to get the production up. We've got 4 platforms there, and the main platform, Etame, we modified to also be a central processing facility. I think, as I've highlighted before, we're looking at the development program in 2025 and 2026 to take account of our opportunity to rehabilitate the Ebouri field, get that going. That's been shut in now for over 10 years, partly shut in for 10 years. And also look at some other opportunities in step out for Etame, and also see if we can explore some exploration opportunities that we've identified on the block as well. So the block itself, the company's been in production since 2002. With this field, we've extracted more than 130 million barrels of oil. So it's been a great field, and we're looking to see with this drilling program, can we take the longevity of that asset? It's currently at 2032. Can we take it to the mid 2030s or beyond? And that's the objective of the drilling program.
Do you think you will prove up more reserves with a drilling program, or will it more be drilling existing reserves? If you could add some color to that.
Yeah, definitely the plan is to prove up more reserves. Obviously, we've got some exploration prospects in the portfolio of the campaign. So should they be successful, that will all be new reserves. The rehabilitation of Ebouri I mean, currently those barrels are contingent resource. So again, if we can successfully exploit these, that will be anything from 7 to 12 or 14 million barrels coming into reserves. So the step outs are exploitation of 2P or existing reserves, but there are a couple of triggers in the program to add substantial reserves into the Etame.
Will it be in similar scope as the drilling program you had? I think it was in 2021 and 2022.
It's a different scope. In 21-22, we were targeting different reservoirs. So we're looking at deeper targets in the Dental for two of the wells, which were not as successful as we hoped they would be. So in this campaign, we've left the Dental alone. We're still looking at studies on the Dental to see how best we can exploit those in the future, and we're focused on the main reservoirs that we know are very prolific. So that's where we're looking at for this campaign. So that's the only change. This campaign is also going to be probably a bit larger than the previous one. So we're looking potentially, 5 to possibly 7 or 8 wells. And with that, we're giving the asset the best shot of the opportunities to get us to that mid-2030 target.
How do you think you will deal or address the issue with the H2S hydrogen sulfide at Ebouri?
Well, there's been a solution for this for some time. We had a mechanical solution back in 2016. The company had that solution, which required an additional platform and a mechanical solution topsides, and the cost was around about $250 million. So it was cost prohibitive in that oil price environment. We've since looked at other opportunities. We have been producing from Ebouri using downhole chemical scavenger. It's just how efficient that can be. And we've been running tests recently to see what longevity we can get with those types of mechanisms. So the first solution is to look at the chemical solution for downhole scavenging. But we've also looked at the mechanical solution. So rather than looking back at the 2016 solution with a new platform, we've looked at can we get the sweetening kit in such a form that we can put it on the existing platform. And that opportunity does exist, and we've costed that out at around about $80 million, so it's cost effective. But the more efficient one is the chemical solution. We've been running tests on that in Q2, and we'll have an answer and results of that ready to deliver probably by August when we come back to market. So, and it's all about the chemical balance. Can we achieve the correct chemical balance downhole, and how long that will last before the H2S gets to too high a concentration and needs to have a different solution.
Fantastic. And how much contingent reserves are we talking about in recoverable barrels at Ebouri?
The enhancement, if we are successful in this program, it could be from anything from 7 to 13, 14 million barrels. Just in Ebouri. That's excluding the exploration prospect.
Perfect. And you own, I think, 58.8% of the Etame field. The rest is owned by Sinopec and PetroEnergy. Yeah, what's your view on consolidation of the field?
I think our view, when we look at where our strategy is, we're very comfortable with the position we've got right now. We do, when we look at consolidation opportunities, we tend to look outside of just the license space. We're looking, are there consolidation opportunities to achieve a bigger footprint in Gabon? Is there opportunities to have a footprint in other parts of Africa, or grow the positions in Africa that we're currently in? And so I think we're very comfortable where we are on the Etame field right now, with the equity levels we have and the operating plans that we have. So yeah, I mean, if things change all the time, but at the moment, I think we're happy where we are.
To move on to Egypt, could you explain your operations in Egypt in terms of field life, development, and oil quality?
Well, we've been doing lots of work in Egypt over the last year. As I said, our work has really been surrounding the efficiency of the operation. How do we drill more efficiently? How do we produce more efficiently? How do we operate more safe, with a safety consciousness that we tried to install, and that's been very successful. We've started to look at where we can. I mean, again, we've got a field which is been in production for some time, so you're looking to how do you, with it, as I say, the mantra is quite similar to each asset that we operate or are part of. How do we get longevity in there? You can only get longevity by stepping out and looking at other opportunities, either deeper plays that may be interesting for us, or step out opportunities with additional blocks through the same joint operating company or other joint operating companies. So certainly, there's no point, when we make new country entries, as we've done in Cote d'Ivoire, as we've done in Egypt, there's little point in just running that single asset to the ground. You have to take advantage of your in-country. How do you maximize your position in country? That means you need more production. So our operations, I think, in Egypt right now are exceptionally efficient. We're getting as much out of there as we can. It's been a challenging environment, but I think we've performed very well in 2023. Hopefully, we see the economic situation improving, and that means, as the economic situation improves, the investment position becomes brighter and more capable, more palatable, so we can look at enhancing our investment and building our position in Egypt. That was the intention when we first went in there. And like I say, our focus in the first 12 months has been really getting the levels of efficiency in establishing that, and then looking outwards to where we can deploy that expertise further in Egypt to enhance the footprint.
Okay, so but just on your existing operation or development, how do you see production evolving in the next sort of 2 to 3 years?
Yeah, as I said, there's two things there. We're looking at an additional opportunity where within the existing field to drill into a separate formation. It's a bit more challenging, so we might have to run a couple of wells to test that. And looking and following that formation as it leaves our acreage and goes elsewhere, we also have to then look at, do we step out and follow that, as we've been doing in Canada, and getting into the areas next to us that afford us to continue to exploit that opportunity. So it's going to be, there are enough organic growth positions to keep Egypt very interesting for us, but we also have to look at inorganic positions where we start to leverage our in-country position. And again, we'll be saying more about that in August when we can talk a bit more freely on some of the things we're looking at. But it's definitely a core area for us. It's not an area we're looking to run down. So it is an area where we need to see how we can maximize the economic value that comes out of Egypt for us.
You said export some of your oil sales of your oil barrels through offshore and some through onshore, and you get $8 to $10 better pricing when you do it offshore. Could you add some color to that, and if you think you will be able to sell more through offshore in the future?
Yeah, I mean, one of the key things here is, yes, of course, in 2023 we've had a number of offshore cargoes, and does that make a difference? Yes, it does, because you're setting a price for the crude as it goes into market. However, with the issue that Egypt has been facing, they've been looking, and the reason we got many of these cargoes was that the refinery didn't have the capability to produce the crude. Refine the crude that we produced. They've amended that, and they've been testing this crude through the refineries, and it's been working. So we'll see a bigger proponent going into domestic, but we're still looking at the discussions with EGPC to at least get the export cargoes that we feel make a difference to the investment profile. And I think the investment profile in Egypt is still very economic, it's still very strong. when you add an export cargo into that mix, it becomes compelling. And that's the message we're trying to get through, that we want to make our investment profiles compelling against the other assets that we have and against the other opportunities in the market. And whilst we continue to invest in Egypt because it is economic, it does provide a return, we want to try to move into the compelling bracket. Those are the discussions we're having with EGPC right now.
Moving on to Canada. So as you said in the presentation, you have drilled 4 wells. They were successful. They are, ensuring that production is flat or modest single-digit production. You're keeping the sort of gas to oil ratio intact. If gas prices would increase, say, to $3 Canadian dollars an MCF, how would that change your willingness to allocate more capital to Canada and drill more wells?
Not really. We've got a strategic plan. In Canada, when we acquired Canada, we've now got an operation that I think is very efficient. We've reduced the human resource to fit the requirement. So we've now got the right amount of people and the right type of people there to run the operation that we have there. And we've drilled the 4 wells this year so far. We're planning a 5th well that will be drilled in August in the south. But yeah, I don't think it would change our investment strategy even if the gas prices went to $3 per MCF, because we're looking at we're mainly in the liquids business and NGLs when it comes to Canada. You saw that in the presentation earlier. It had quite the gas ratio was increasing, but with these new wells, we've pushed that back down again. So, direct answer to your question, no, I don't think it would change our Canadian strategy if we were at $3.
So then, Equatorial Guinea. Could you give us an overview of your development project in Guinea?
Yeah, we've had this block for some time now, and yes, there's a deep water prospect, Southwest Grande, which is out to the west of the block. It's really a deep water prospect that isn't fitted to a company our size. It's really for someone with much larger pockets. But we do have a development in shallower water that can actually be drilled from off the shelf. I mean, the vertical location of the subsurface target would be in about 1,100 meters of water, but you come 3 kilometers towards the beach or to the east, and that shelves up to 130 meters of water depth. And 130 meters of water depth is what we play in all day long. That's where we are very strong at. So when we put this development opportunity together, we put it together on the basis that we would drill from that shelf location through the shelf and down into the target. Now, it's not a huge accumulation. It's about 25 million barrels of 2P, and it doesn't have a long life. I mean, once we get it in production, it's probably got 5 years to fully evacuate it. But once we get it in production, it does allow us potential to tie back other opportunities to that infrastructure. So it's not a fast track development because of how we're developing it. So we need to be a little bit patient on the feed study, and then from that feed study taking it to FID, because it evacuates most of the oil in 5 years. It's economically very, very profitable, but it also means that we can't invest too much capex because we won't recover all that capex pool, which is why part of the feed study is looking to see how much of that we can flip to OPEX and therefore reduce the capex sink. So it's an interesting development. It's an initial entry point for us to EG. We're looking for other opportunities there that would again augment the footprint that we've got. It's the same thing we do in Gabon, same thing we're now doing in Cote d'Ivoire. How do we build these positions that we've entered into to become more dominant in these areas and get the efficiencies for our operations? But EG has been on the books for a long time, and I think we're getting to the point now, through all the political issues and all the partnership issues, that we're getting into the project phase now, which is a lot more interesting and exciting.
And so from what I'm hearing now, the production profile should be somewhere around 10,000 to 12,000 barrels, of which you have 60%.
Yes and no. The production profile we've got is probably closer to 15 to 17,000 barrels. And because of the carry arrangement, we'll be in the initial production, we'll be somewhere in 86% of that, somewhere in the region. So because of the carry arrangement, we'll have a lot of that production in the early stages, and then as the carries are paid back, it will be some time before we go back to our working interest position. But at least through the first initial 2 years, we expect to be well in excess of our working interest.
But you expect to sole fund the project until first oil?
Yes, we'll be sole funding. That's and that's what we explained in the Q1 results. We've got commercial arrangements on with the partners with SOFR plus 7, and as you saw on that presentation I gave earlier, with that arrangement, we actually enhanced our 1P recovery position.
What is the timeline on the FEED study and the final investment decision?
The FEED study we should complete by Q4 this year, and that will contribute towards FID depending on the outcome we get, particularly on equipment availability. But yeah, so we should be completing the FEED study there and then moving towards FID probably Q1 25. And then we'll be into equipment selection and contracting.
You're an Africa-focused E&P, but you have a small Canadian asset. What's your strategic thinking around Canada?
Canada, I think we've explained it a number of times because it does look like we're focused on Africa, but we've looked at that operation and we've put together a strategic plan how that operation will perform over the next 5 years. And the key message from us is that as long as this asset is contributive to our overall goals, both in cash flow and EBITDA, then it makes a difference. So the word strategic, as the world moves on, it moves around. So strategically, a lot of our expertise is in Africa, but inside the company, we've got expertise all over the planet. And as some of our areas become more competitive in the process world, we've got the IOCs looking to retain lots of their assets now rather than farming them out. We've got a lot more competition coming into Africa from other places where the environment is not so economically friendly towards oil and gas companies. So we also have to adjust. We have to look at where we can see value creating opportunities regardless of where they may lie jurisdictionally, as long as we feel within the company we have some kind of niche or expertise to make a difference. And that's really where I think the market's moving to, where yes, we've got great opportunities and we're very experienced in Africa, but we also have to recognize that we've got some strategic goals we're trying to achieve for the company. And if we can achieve those in another jurisdiction where we feel we have a competitive advantage, we have to look at that also.
And then could you give us some insights then what type of assets are you looking for? Where are you looking?
Yeah, we kind of obviously the best source of opportunities are in the existing footprint that we currently have. So in Egypt, in Gabon, in Cote d'Ivoire, in Equatorial Guinea, where we have people on the ground that are talking all the time to other operators and to the regulator and the government. So they're the best source of knowledge for where we could step out quickly and grow. But that being said, there are scale is a key thing in the public markets, and diversification of risk is key. So the more that we have, we de-risk our revenue stream and our cash flows, the more attractive we become. And that's a key consideration for what we look at in the inorganic space. What does it do to our existing portfolio? Because we can't go and take on the whole world. So we have to look at our existing portfolio. that already has a number of catalysts in it over the next 3 years of significant growth. I mean, I see significant growth opportunities to hit our targets of well north of 40, 50,000 barrels working interest through this portfolio we have already. So anything we look at now has to fit financially into that structure. And then it has to be contributed to that structure. So it's getting more challenging to find the ones that fit and the ones that fit for value, because we're not the only company with a growth strategy. There's many of my peer groups trying to do exactly the same.
That is true. It's competitive. What's your willingness to use equity with regards to M&A?
Well, we used equity to acquire TransGlobe, and I think that it's always challenging to use equity. You have to be very much prepared to demonstrate the value that the acquisition is contributing to the existing shareholders and the new shareholders that are coming in. In the previous acquisition and in the last acquisition, we've looked at it for cash, and we've done that for cash. Again, it has to, anything we look at from an acquisition standpoint has to, again, fit into the existing commitments we have with our portfolio. So are we planning an equity raise anytime soon? Absolutely not. That's not on the agenda. But there's hopefully enough other instruments in the market to allow us to grow without continual dilution. I think that's I think if we continually dilute, you start to devalue the stock price because everyone's just expecting the next one. And I think there's enough opportunities in the marketplace to get to the growth levels that we're hoping for, the stock price levels that we're planning for, without the constant dilution. However, there are some acquisitions where the target company will only take stock because they want participation in the growth story going forward, the same as our shareholders do. So it's never our first thing out of our trunk. We're normally looking at other instruments. So not a key. It's not a key plan to be deploying that strategy.
If you don't buy anything new in the next 12 months, how do you expect to deploy your excess free cash flow?
Yeah, and I think with over the next 12 months, we've got some pretty interesting capital programs coming up with Gabon and with Cote d'Ivoire. So I don't think we'll be opportunities restricted for where to deploy the capital. The excess cash flow. So that's not an issue. I also think when we look at the acquisitions, to say, well, I'm going to go and use my operating cash flow to acquire something today, I'd have to be able to demonstrate that by doing such a thing, I'm not jeopardizing the investment cash required in 2025 for the existing asset base. So there's a balance there of what do you do with the cash that you're generating now, and I think we've got lots of areas we can deploy it, and not overcommitting that cash stream to do inorganic opportunities to the detriment of what we're trying to develop with our existing portfolio.
Where do you envision VAALCO Energy in 3 years?
I would hope that our growth trajectory could be maintained. We can maintain the path we've had for the last few years. So we have grown the company on a stock basis 6 times and on a production basis 5 times. So and as you get bigger, it gets harder to maintain those metrics. But certainly we would be looking to, in the next 3 years, as I mentioned, from our organic position with the assets we have right now, I see significant production growth. So I can't see a 5 times from our organic, but I can see potentially a 2 times from where we are today, at least a 2 times. Will that 2 times in that 3-year period get us to where we want to be financially in the marketplace? Yeah, it should get us up there. I mean, the As soon as we start delivering the production from these assets that we have, the cash flows coming out of those opportunities in 2028, 2029 will be substantive. But how long does the market wait? So, yeah, would I look to see further inorganic growth opportunities? I hope we can take advantage of those. I hope we have balance. I think we have the balance sheet strength right now, where some other companies with lower capitalizations are perhaps struggling. So I think there are opportunities there, but I would expect us to at least be double the size we are today, if not more.